So shall we start now?
Oh yes, I am ready.
Okay, sir. Okay. Yeah. Hello all. Sushma here from IIM Bangalore Alumni Office. Thank you all for joining the webinar today. And speaker of today's session is Professor Thillai Rajan. His profile is like he's a professor in the Department of Management Studies at IIT Madras. Recently, he co-founded YNOS Venture Engine to enhance the efficiency of early stage venturing and innovation ecosystem in India. The YNOS technology platform helps early stage entrepreneurs identify potential investors, estimate the valuation, and among other things. And he is also producing for 10 years the annual India Venture Capital and Private Equity Report. Recently, he has been instrumental in setting up the IIM network, a consortium of IIT Madras, IIT Bombay, IIM Bangalore, IIM Calcutta, and IIM Kozhikode to provide research leadership and innovation and venturing in India. He regularly publishes in Term Business Dailies. Previously, he has been a Chevening Gurukul Fellow at London School of Economics, and is an Executive Fellow at the Macquarie Graduate School of Management, Sydney, and Fulbright Nehru Senior Fellow at the Harvard. And is also an alumnus of IIM Bangalore and of FPM 2000, which is equivalent to a PhD. And as you all know, today's topic is like how is like after the post-COVID startup investment is going to be. And he's a veteran in this the startup area. So today's sequence of the session is like sir will be presenting the webinar and he will be taking the questions, and you can all type the questions at the chat window. And the session will be recorded and then it will be uploaded to the YouTube. Maybe tomorrow or day after tomorrow you can find a recording of the session. And yeah, at the end we'll be sharing a webinar feedback. Kindly fill it. If you have any questions, any doubts, or any problem, please type in a chat. Yeah, over to you, sir. Yeah.
Good afternoon, Sushma, and all the help that you have done in facilitating this webinar. I hope I am audible to the participants. Sushma, am I audible clearly?
Yes, sir, you're audible clearly, sir. I request all people to say yes if you're able to hear the chat window.
Yeah. Okay. Yeah. Good. Great. So I'm happy that this is probably one of the few webinars where we have started without a glitch. So normally in all this, invariably what happens is in all these presentations there is a technical glitch that makes its presence felt, and this time it's kind of been smooth. And so let me start off. So in addition to what Sushma has said, so I have been having different hats in the venture capital industry. After graduating from IIM Bangalore, I was working in the venture capital industry as a venture fund manager. So that was, it seemed to be a different era. Looking at it now. So that was the first wave of what is called as the startup wave in the country in India, where many first generation entrepreneurs started founding their own companies. That was popularly called as the dot-com boom. Right? So many of you might not have even might not have been fully aware of this, but then I can tell you the excitement of the dot-com boom had been seen to be believed. The activity was so much more feverish than what it is even now. Today, you have multiple actors supporting, you have the government and all of these people supporting. And those days when practically there was no little support from several stakeholders like we see today, the entrepreneurship was thriving. And from that time onwards, when I get into academia, I have been continuously studying and researching. I have been kind of observing from the sides how the industry has evolved over a period of time. And it's been fascinating, and I kind of been very fortunate to interact with so many observers, so many entrepreneurs in the last many years. What I'm going to do right now is today, for entrepreneurship, this is a major challenge, not in terms of challenge from a very internal standpoint, but challenge from an external standpoint. because some of the factors of production that we talk about are going to clearly pose a challenge in terms of going forward. So I have put together this presentation mainly for the entrepreneurs, right? This is targeted mainly at the entrepreneurs, but at the same time, I don't know if you have heard about what is called as the Femina effect. Right, Femina effect, as we all know, Femina is a magazine that is published by the Times of India Group, and as you all know, it is predominantly targeted at the women or the girl segment. Right? But sometime back, when they did the survey, they found out a majority of the readers of Femina were men. Right, so that was a very revealing finding that the publishers found out. Right. That most of the people that wanted to know about women, they started reading Femina, and the target group which it was targeted for actually formed. It formed the majority of it, but then the interesting finding was most of the men started reading. So from that time onwards, this Femina effect was started being used in multiple contexts. So today, the reason I am using the Femina effect is it is possible that there could be some investors also who are attending this presentation, because I am going to talk about investors to the entrepreneurs, and it's possible that investors might be aware that they would like to know what is being talked about investors among the entrepreneurs. Nevertheless, anything that I'm going to say today, if you have a different opinion, I'd be happy to engage with you. What I am going to talk to you about in the next couple of slides is about our findings that we have done over a period of study and research in this particular sector. Now, kind of moving forward. So ultimately, we all know today is period of major crisis, and I would like to start my webinar with this quote by John F. Kennedy. So if you go to the US, John F. Kennedy is a very charismatic persona even today. Though he expired several decades ago, his name is synonymous with energy. His name is synonymous with charisma. His name is synonymous with kind of having a very strong public opinion. So the way he seemed to have defined crisis is in Chinese. It has two brushstrokes for crisis, and one stands for danger and the other for opportunity. And in a crisis, we have to be aware of the danger, but we should also recognize the opportunity. So we are really at a crossroads now, where on the one hand there is a tremendous opportunity, and on the other hand there could be an existential crisis for several startups, because as I just mentioned, the macro environment has suddenly become very hostile. And as entrepreneurs, most of us are very eternal optimists. So I am kind of including me among your fraternity, and I say yes, because in a way I am also wearing the hat of the entrepreneur when I am trying to kind of run a company like YNOS. So we have to be aware of and recognize the opportunity that we see today. So in the last let's say 6 weeks precisely, there's so much that has actually happened in terms of fundraising, right? I mean, I don't have to kind of mention you here. There are several companies that have used a very favorable environment today to be able to fundraise, right? So if you really look at debt, or if you really look at the equity market. In an equity market, obviously the best example that we can today think of is the geo platforms. Right? So remember, if you really look at it in over 6 weeks, the company has raised close to about 88,000 crores from private equity investors. So now, what is interesting about it is this, right? So you may say that, oh, it's Reliance and therefore it's Mukesh Ambani, so therefore he can do anything. The sky is the limit for them, and so on and so forth, right? So that is one end of the spectrum, right? So the other end of the spectrum, let us look at from the perspective of private equity investors who have invested in Reliance Jio. So remember, these private equity investors are in their own right very big names by themselves, right? And they are not going to make an investment just by going by a brand name or by, let's say, the reputation of the founder or the promoter, unless until there is a very clear business case, right? So in most cases, though the announcement has actually happened now, the entire process of fundraising exercise would have started months ago, right? If you assume that on an average, it takes about 3 to 4 months from the start to the finish to complete a fundraising process or to announce a fundraising process. So essentially what we are looking at is a situation where many of the discussions started pre-COVID, right? Possibly they would have started in December or January, but then culminated now during the COVID time. So this indicates two things. These large investors who had previously made a mind to make the investment have not gone back. So in the sense that they feel that there is a tremendous amount of opportunity that exists even today. It's not that these companies have gone back on their commitments and said they are not going to make the investment. All of them seems to have followed upon their original commitment that they would have made at the time of starting the diligence process. We may also look at several examples of companies going ahead and raising debt, right? Because debt markets, if you really look at it today, they are at a price that is so favorable. The yields are extremely low in the sense that today when the company wants to issue a bond, they can issue it at a very, very low yield as compared to what it was existing. A couple of weeks ago, again RBI looked at further slash down, the basis points by 40 basis points. So many of the companies, which are kind of looking to raise capital, they have not found any difficulty at all in terms of raising capital, irrespective of the very, very poor business environment. Now, some of you can come back and then say that, okay, these are all very large companies and their challenges are very different. Whereas if you look at the startup, the challenges are very different. Now, I completely agree with you that the challenges are extremely different when compared to a startup vis-a-vis a large companies like HDFC or Reliance and so on. But nevertheless, what I wanted to highlight here is this, that investors don't seem to have a conflicting opinions as far as the opportunity is concerned that is going to come up in the future. Okay? What could really happen is, there could be some kind of delays and so on in terms of making an investment happen, but it's not that it's going to come absolutely zero. So as startup founders, we can take solace from the fact that there is still strong investor interest to make investments in companies that they see a strong potential in. So now this is a curve. Today, if I show it to probably any kindergarten student, I think even they'll be able to find out what is this curve, right? I mean, today, as we all see, people at the kindergarten level, they have started using online tutorials. Surprising as it may be, that is the reality today, right? So if you really show this curve, everybody will show that, oh, this is a typical the corona growth curve, right? Where there is a period of gestation and then there is a strong exponential growth. And then they have multiple scenarios. What will happen to the growth if we implement social distancing and if we don't implement social distancing? And then when we implement social distancing, there is a flattening of the curve, right? So that's the kind of curve that today everybody is familiar. So people are today afraid of this curve. People wanted to see how much they should kind of flatten it as quickly as possible. But then we should also remember that this is not a curve that is new to us. And in fact, as entrepreneurs, we will all be familiar with the curve that we are going to see here. Right? So traditionally, this curve is what every entrepreneur would try to dream for. It's a dream to, or it's an inspired curve. So it can be called as an S curve, it can be called as a hockey stick curve, or it can be called as a J curve, or whatever you may name it. So this is a curve that as entrepreneurs, most of us wanted to aspire to show our contours to be. So there is an initial gestation phase, right? There's an initial gestation phase, and then we have what is called as a hockey stick growth, and then there is an inflection point where very few companies move from the gestation period to the hockey stick growth, and then finally the growth tapers off during the maturity phase. So we are not very unfamiliar with the curve that we are seeing today, but the challenge is to see how we could move over to the inflection point in this current business environment. So essentially, let me start with this. Right? So we are, as an early stage entrepreneur, our ambition is to transform ourselves from who's he to who's who, right? So that's what the most of the early startups aspire to be, right? So when you start a venture, when you start your business enterprise, and obviously the founding team is relatively unknown. Right? So when there is relatively unknown, what are the major challenges? Right, the major challenge is there is something about the credibility of the promoters. Right, nobody has any track record in terms of what will be the performance of the promoter and so on and so forth. So under those circumstances, there will be very few external investors who is willing to invest in the entrepreneur. Then what really happens is, under who's he phase, we essentially talk about the founder capital. The founder will have to put in his money, and then we can also look at incubation and small grants. I understand that many of you might actually be part of incubation center. And then after that, it's also important that you try and get some amount of investment from your immediate or related family. Right? So that's basically the stage. And before we actually become who's who, we have to go through a series of stages. Right? The first stage would be essentially looking at trying to get some angel investors. So now you can always ask the question, do everybody have to go and raise external capital before becoming the who's who? And my answer is not really. I mean, there are companies who are very well positioned to do bootstrapping and so on and so forth. So, but still in today's context, those businesses form a very small portion of a business. Businesses that are completely funded internally are very small. I mean, the reasons are several, but let us not get into in this webinar for those. So I am going to focus largely on those companies that willy-nilly look at raising some external capital to fund their growth. So the first stop for investment are going to be angel investors, because because they are the segment who can take a little bit more risk as compared to the institutional investors, and they can stay invested in the venture for a longer time. They can give very small amounts of capital, and in a way people feel that they also speak the language of the entrepreneur. And so in a sense, there is a very good connect that can be established between an angel investor and the founder. So therefore, that happens to be the first stop for external capital. And then you have venture funds. Once you get angel investors, then the next step is to go to seed funds, venture funds, private equity, and so on and so forth. Obviously, this comes with large amounts of capital. They also look at a certain amount of traction before they make an investment, and their investing horizons are much smaller as compared to angel investors. And then finally, when you think that you have arrived in life, when do you actually arrive in life? So, for example, from a business perspective, if your startup becomes, let us say, for example, as well known as, let's say, Infosys, or you have Mindtree, companies that can self-sustain, right? They don't have to depend on external investments, right? The business generates cash, and that cash is enough to sustain the business, right? So that's when you literally say, okay, I have arrived, and I should be called as the who's who of business. So it could be, it could also be in terms of able to raise money to a public offer, or to being able to get acquired through an M&A, and so on and so forth. So the transformation that happens from who's he to who's who, the first step of the transformation is to really look at angel investors. So that's going to be the focus of my talk today in this webinar. So ultimately, what do these funds provide to startups? If I may just take a small little bit of water break here. in case if you remember, a couple of weeks back when Prime Minister Modi he talked about the 4 major pillars, right, in which there has to be some kind of a support given. So the one was labor, the other was land, and then the third was regulatory, legal, on law, and the fourth was liquidity. Right, to be able to provide capital for early stage startup is very critical. So if you look at the different major funding sources, those that provide liquidity for early stage startups, you can classify it into these 4 categories. So you have the angel investors, then you have seed funds, then you have government agencies, and then you have debt. So let's quickly understand that main differentiating features between these 4 different agencies that provide early stage capital. So if you look at angel investors, they don't have any specific category. They have very broad categories, right? For example, I'm investing in tech, right? I'm investing in manufacturing, right? So that's a kind of very broad definition that they have. On the other hand, if you look at specific seed funds or any of the funds, they have much more very specific sectors. For example, they say I'm going to invest in clean tech, or I'm going to invest in funds that looking at a ticket size of about $5 to $10 million. So they are very specific. And angel investors are also characterized by speed, right? They are willing to take decisions much faster. They are willing to make investments much quicker, and so on. And finally, angel investors, in most cases, they spend a lot of time with the entrepreneurs. So they wanted to do what is called as value addition. And now that is very important, right? So most of the angel investors, they really want to contribute and see how much they can help in the growth of the business. If you look at the seed funds are essentially looking at, they have a very well-defined sector. So you take up a proposal, and if it does not fit into their specific defined sector, they are unlikely to be able to look at it. Right? The exceptions will be very rare. The quantum of capital that they are going to receive will also be much higher. Seed funds can provide value addition of a different magnitude as compared to angel investors. In the sense that being institutional funds, they'll be able to take you to overseas markets. They'll be able to help you to recruit a high quality talent, and so on. So, but the most important characteristic of seed funds is they invest large sums of money, but then they are very clear about limiting the size of the portfolio, right? Because they may not really have time to be able to spend on a large number of companies. So therefore, they are very careful in terms of which of the ventures that they spend time on, and that also reflects in their investment decisions. So in a fund, normally you don't find more than 10 to 14 portfolio companies, correct? So therefore, it's a very tightly controlled kind of investment activity. So this is what I call all for some, in the sense that they make their bets. They place large number of bets on very few horses. Right? Now let's look at the government agencies. Right? The government agencies, again, they have well-defined areas for support. Right? Because the government agencies do not have well-defined areas, it may become very difficult to justify on what basis an investment was made. So government agencies, the first thing is they have well-defined areas for support. They take a long time. Sometimes they may take as much as 6 months. So I can personally know of instances where some of the incubation funds that were recommended for investment for a sum as low as 6.25 lakhs, it took about 6 months to get approved, right? And after 6 months of approval, the first tranche that came for 1.5 lakhs, and upon submission of spending for 1.5 lakhs, then you will get the balance, right? So sometimes what happens is this kind of a long time frame can be a completely anathema for the entrepreneur, because for entrepreneur everything happens to be in a hurry. It should have happened yesterday, but if you take really this kind of a long time, it's not going to be very helpful at all. And then they have to limited value addition. You cannot expect the government agency to help you with recruitment, to help you with opening doors, and so on. So they give the money, and that's about it. But most important difference is what is called as the sum for all. Right? Government agency, it really looks at the welfare for as many beneficiaries as possible. Right? So normally what they do is, if they have 100 crores, they would prefer to give 50 lakhs to 2,000 companies, to 200 companies, right? Rather than looking at 10 crores for 10 different companies. So it's a question of sum for all. Each and every startup should get little amount so that everybody is able to survive. Right? Everybody is able to survive. And next you have debt. So obviously startup entrepreneurs, one of the main features that makes debt unattractive is the interest outflows. You'll have to periodically keep giving interest, and when the cash flows itself are difficult to come by, how do you manage the interest outflows? So that is one. And second is lack of collateral, right? So today, how much ever the government says that we are not going to ask for collateral and all of those, in case you have not had the experience, if you go to the reality and then check, very difficult to be able to raise loans without collateral. It possibly exists in the books, but very rare. And then there is what is called as a poor appraisal of risk. The bankers, they speak a language that is very different from what the entrepreneurs do. So what would be the post-COVID impact? Right? So this is what I wanted to highlight. Right? First is, let me talk about debt. Right? So we talk about debt. As far as the startups are concerned, this is not going to be very attractive. Right? It's going to be a downward trend. There is a pervasive NPA problem, and because of this, the banks are going to be extremely conservative as far as going to be able to sanction loan without collateral. And wherever possible, today the flavor of the day is to be able to support people who already have existing loans, not somebody who is going to take new loans. So that's a big constraint that we are seeing today. And then we are also looking at short-term demand is fairly unclear. Right? Short-term demand is fairly unclear, and nobody knows whether you'll be able to generate revenues for the products, and unless until you are able to generate revenues to meet the interest payments, it's very unlikely that you'll be able to service debt. So then we talk about government agencies. So this is something that I want you to clearly understand. What is the thinking of the government today? So right from 2015, when the current Modi government came to the picture, till the beginning of this year, there was so much emphasis given to startups. In 2015, in the Independence Day, when Modi said Startup India and Stand Up India and Startup India, it was creating such a major impact on the startup ecosystem in the country. And from then on, each and every budget that the government made had something or the other for startups. Right? So there was always a very favorable environment. But a few weeks ago, when the government made a thing saying that they are going to look at providing a stimulus of 20 lakh crores in 2020, and then subsequently you had our finance minister Nirmala Sitharaman came out and make an announcement over 5 different days. So in case you have looked at the press announcements that Nirmala Sitharaman made for 5 different days, one single stark observation that you can make is the word startup had not been mentioned even once for entire 5 days. Right? Then suddenly the focus seems to have shifted to what is called as the MSME segment. Right? So now, if you think that MSME segment and startups are one and the same, it is not really the case. They are as different as chalk powder and sugar. Right? The thinking is completely different. The way in which the industry function is very different. The kind of markets or services is very different. So the dependence on technology is very different. So MSME is a very different animal. So much so that there is a different ministry that looks at MSME. Startups broadly comes under the Ministry of Commerce, whereas MSME looks at the Ministry of MSME itself. Right? So the government stance seem to have overnight shifted from supporting startups to MSMEs. So therefore, that's the reason for me to show the downward thumb as far as the government agencies are concerned, right? At least in the near term, the attention of the government is not going to be so much focused on startups, right? It's going to be more focused on the traditional areas of support that they have been looking at. So then we come to the seed funds, which is second last one that I want to talk about. So in seed funds, what is going to happen is, obviously, whenever there is a problem like this, most of the limited partners have a history of withdrawing their commitments to the funds. So that means what happens is the funds might not really get the capital to make investments, or more importantly, what is actually happen is the investors, the investment committee will delay many of the approvals that the funds take it to them, right? So therefore, the seed funds are going to have enormous difficulty in getting the approval of the limited partners to be able to carry out their investment activities. Right? So that's one. And second, most of the seed funds, given the fact that when the LPs are going to withdraw the commitments, it's going to seriously impact them in terms of their fees, right? So they are not going to get their management fees, and in the absence of the management fees, many of the seed funds may not be able to sustain, and they will cease operations. So therefore, I wouldn't actually put a lot of bets in terms of seed funds being active in the post-COVID. And finally, you have angel investors. So angel investors is, I think, is the one segment that we can all count the bets on, right? For example, why should the angel investors make an investment? Because one is they are all individuals, right? They don't have to take anybody's approval to make an investment. They can go ahead and make an investment on their own, right? And second, most of them, they want to help entrepreneurs. So that is basically a major objective for angel investors, and they feel the best time they can make an impact on entrepreneurship is now, right? When chips are down, that's when they feel that they can make the best investment. So therefore, you may have to really look at angel investors as a very, very promising source among all the other categories that we have seen so far. So it is in that context I am going to talk more about angel investors, right? So now, when you look at the title, you may see that, okay, what should what was the last man standing do, right? So somehow, many of you might get, I get disturbed. Why am I saying specifically with reference to, the male gender, right? I'm saying it is, nothing intentional, but it's more, it's a figure of speech. But I should also like to emphasize the gender issue that we see among promoters and investors. So, for example, we took a large number of startups today, and then found the proportion of women among the promoters. So, essentially, what you find is, the male gender accounts for 87.4% among the promoters, whereas women account for less than 10%. Right? So that's this whole segment seems to be driven predominantly by the male gender. So I have no role to play in that. I'm just simply highlighting the fact that that is the case, right? Whether this is the right thing or something is a different. There's a different opportunity to debate. But this is the situation that we will have to recognize. And among the investors, the proportion of women is even lesser, right? Less than 5% of the angel investors are women. Right? So now, obviously, if you really look at behavioral aspects in finance, there are several factors that influence decision making, right? Two of the major factors I would say that will be gender, and the second is age, right? So gender plays a major role in terms of how people make financing decisions, along with age as well, right? So therefore, when you look at an angel investor, you are looking at an angel investor who is predominantly a male, and obviously, there is several anecdotal evidence that the element of risk taking, right? I'm not saying I'm not saying like gambling, but the element of risk taking is a little bit higher among the male investors. So therefore, you may find active number of investors, angel investors, still willing to look at investment opportunities even in the post-COVID era. Okay, so this is a little bit of cartoon, but the message I wanted to convey is like this: that when you approach an angel investor, do they select investments or do they reject investments? Right. So I think the common joke is when you write CAT for applying to the IIMs, CAT is always a rejection, right? It is not a selection process, right? Because so many students are writing. So therefore, they seem to be finding easy to rejection. But then, if you really look at angel investors, the question is, do they select or do they reject? But ultimately, I would like to point out that most of the angel investors, they basically, they basically look at rejection. So they don't actually losing a good opportunity. They don't mind, but they don't want to invest in a business that has fatal flaws, that is seen as weak. Right? Why so? Because ultimately, if you really look at it, they are investing their personal capital, right? So when they invest their personal capital, they also put at stake their reputation, right? So it's not the reputation of the organization, it's a reputation of the individual. And many of the angel investors are extremely successful and they are very, very careful about their reputation as well. So whether we like it or not, right? So for example, a startup could actually fail because it could actually fail because of various reasons. But then when it fails, it actually hurts the ego of the angel investor so badly. So therefore, they are extremely careful about what kind of businesses they invest in. And so that is something that you need to be clear about before you go approach to angel investor. So if you look at an angel investor, there are 4 categories. So one is you have the regular investors, right? Regular investors, which you may call people like Rajan Anandan, who's basically a very large angel investor. So then you may talk about Chris Gopalakrishnan, Ratan Tata. No, they are regular investors. Every day, every year they make let's say 10 investments, right? And then you have occasional investors. They make an investment in a year, then maybe they are silent for a couple of years, then they again may make an investment. So they are occasional investors, right? So remember, each and every investor has a characteristic. So you have to basically understand the nature of the beast. Right? So regular investors will be extremely careful now to look at businesses because they already have a very large portfolio, and then it's possible that many of the startups might be able to might have to close shop. So therefore, they'll be very careful. But on the other hand, you have occasional investors. Occasional investors, they are not fully aware about how the market works. People who have missed the bus in the earlier scenario, they would still be available. They would want to look at opportunities to make an investment, right? So therefore, I think the markets are not better to approach occasional investors rather than the regular investors. And within angels, you also have business angels and financial angels. Business angels, who are the business angels? Business angels are most likely to be entrepreneurs themselves. Entrepreneurs who made a lot of money from their previous business, and now they want to invest part of their money to kind of entrepreneurs. For example, if you look at Sachin Bansal of Flipkart, he could be an example of a business angel. Or if you look at Anand Chandrasekharan, who is a part of Facebook, he could be considered as a business angel, right? So for business angels, it is basically the kick that they get out of investing. That's what matters. Right? And then on the other hand, you have financial angels. Financial angels are those who are rich individuals, but they may not really have business experience, right? So financial angels are those who probably are doctors, they are lawyers, right? In some cases, it could be actors. Sachin, Mahendra Singh Dhoni, when he makes an investment, he could be a financial investment, right? So I actually met one of incubating company at IIM Udaipur a couple of months ago, and then in this company, a politician has invested, a local MLA had invested, right? So that's a financial angel. Right? So if you look at an angel investor, there are these different kinds of categories. Among these categories, I would think the occasional investors are the one that I think will be more approachable to making an investment now. And between business angels and financial angels, I would still think business angels will be the most appropriate to go ahead and look for an investment. As to why financial angels will not be interested, I'll probably come back to it a little later. So let's look at the angel investors landscape in India. Right? If you look at the angel investors landscape, out of close to about 2,000 angel investors that we have, so what you find is the occasional investors are by far the largest, right? So 1,029 who have made only one investment. So they are essentially the occasional investors. They don't really have. So this number is basically the biggest, right? They are at least more than 2 times of those who have made 2 investments. So when I said you have to approach occasional investors, India's angel investors landscape is predominantly comprising of occasional investors, and for most entrepreneurs that's a good thing, because in periods of crisis like this, the occasional investors are going to be more active, right? So on the other hand, if you look at people who have made more than 25 investments, there are just 4 of them, right? Among in our database that we analyzed, we could count only 4 who have made more than 25 investments. Right? So this is an important positive factor that I would want to leave you with. Second, if you look at the age of startups at the time of investment, right? So this is also again an important statistic. Right? The chance of getting an investment from angel investors are high in the first 2 years, right? The first 2. If you look at the cycle, if you look at the number of startups, these circles are much larger as compared to those that have 2 to 3 years and 3 to 5 years. So it doesn't matter what kind of environment that we are talking about. The chance of funding dramatically reduces after you cross about 2 to 3 years, right? After that, getting angel funding becomes very, very difficult. Most of the angel funding happens in the first 2 years, right? This is something that again you have to be aware of. So now, if you look at the age of promoters at the time of investment, right? So we kind of looked at about 3,000 startups, and in the 3,000 startups, found out what is the age of promoters, and this is the kind of a graph that you get. Right? So obviously it looks like a classical curve. If you see, much of the highest proportion you find from the age group 25 to 30, right? But on the other hand, if you look at the mean age, because of the very long tail that we have, the mean is little higher as 33.25. So this is a mean age of promoters at the time that they receive angel investment. So this kind of you need to kind of also understand here. Angel investors prefer to make investment in promoters who are in their early 30s, right? So it's not, that's when probably the entrepreneurs are at the peak of their energy. They will be able to spend a lot of time on the business, and so that's what the investors are looking for, right? Investors are looking for the ability to execute, the ability to implement, and that's the highest probably in and around 30 years. So now if you really look at the investors, what do you find? Much of the investors, they make an investment when they are between 40 to 45. 40 and 50 is when most of the investors make the first investment. It looks like a very classic normal curve, right? If you're familiar with the normal curve, there is a tail and then there is a mean, and it's like a very, very interesting curve that we have here, right? It's not skewed to any end. It's almost like a classic normal curve. And the mean age of the investor is 43.35 years. So remember, this is again is important, right? An average age of the promoter is 33 and the average age of investors is 43. So there is an arbitrage of age, right? There is a 10-year difference between the age of investors and the age of the entrepreneur. So now this is something that one has to be aware of, right? So entrepreneurs will have to kind of remember, what will be the kind of expectation from an investor, because he is 10 years senior, right? Obviously, the age being one of the important factors that drive investment. One has to understand the mindset and the mind frame of the investor, because he is 10 years senior, and being 10 years older in terms of age, what all he is going to expect. Will he be able to provide and meet the expectation of these investors? Next, we also look at startup investor proximity, and startup investor proximity. So you find something very interesting here. We kind of split the investments between the domicile, city domicile of the investor and the state where the startup is located. Right? So you find that 35% of the investments of the investors make investments in the same city where they also reside. Right? That's a very, very big number, right? So remember what is going to happen, in times of COVID and all that, right? People are unlikely to be able to travel, right? So how much ever we do working remotely and all these things, the inability to monitor, investment is going to be a very, very big challenge. So therefore, most of the investments are going to actually happen in a place where that's geographically close. So as an entrepreneur, then it becomes very clear, right? So 35% is a significant number. So your first choice would be to see if you can tap as many angel investors as possible in your own city, because the probability of making investment in the same city is much higher, right, as compared to if you're really looking at in getting investments from other cities. So that's probably the reason why you find large number of startups are getting funded in Bangalore, in Mumbai and Delhi, because the local investors there are making a significant investment within the startups within the same city. Okay. So now let's understand. I'm going to quickly wind up here. Some of the major trends in the new normal is there is going to be uncertainty in both product markets and capital markets. So what is going to actually happen is consumers' discretionary spending will reduce significantly. The investment duration is going to become longer, and therefore the startups that are not able to raise money timely, they will die off. But the biggest feature you are going to see is about bootstrapping and the focus on cost. Right? So people would expect them to focus and raise money internally. And there are also going to be new sunrise sectors in healthcare, work from home solutions, personal transport, material science, and so on and so forth. So as far as the investor is concerned, the investment returns that they are likely to expect in angel investing is going to significantly reduce. So typically, if you look at it, an angel investor looks at a return of 35% over a 5 to 8 year horizon. That's what the investor looks at. In today's context, right, what actually happens is, because of the delay in being able to scale up and all of these things, our estimate shows that the IRR can become 21%. Right, IRR being 21% is still not very bad, but then there are other opportunities that can potentially give an IRR of 21%. Today, for example, the public markets can give a high return with the expected, V-shaped bouncing and all of these things. So what happens is, why would somebody invest at an IRR that is a little lower? They would invest simply because they want to be making a contribution to the entrepreneurship. They want to actually dabble in entrepreneurship. They want to help entrepreneurs. So essentially, we are looking at somebody who is a business angel, right? Only business angels will be able to withstand or overlook the slightly lower returns with a trade-off for impacting in entrepreneurship. So this brings to the end of my presentation, and maybe it's time to ask a few questions, and I will leave the slides just to see if there is any question. I will go to the chat box now and then see if what are the questions that we have. So that is one question. What is the primary difference between angel investors, venture funds? Okay, so that is one question that has come up. Well, the primary difference is venture funds don't invest their own capital. They mobilize capital from investors and then they make an investment on their behalf, and that brings in a whole range of complexity. And venture funds obviously are financially more savvy as compared to angel investors, in the sense that the covenants and the clauses that they use can be a little bit more sophisticated and complex as compared to angel investors. Angel investors, they invest their own capital in the sense that if they decide to make an investment, they don't have to answer anybody. Maybe they might have to answer their wife, if it is needed, but otherwise they don't have to answer anybody externally, right? So that's a big difference. They can make decisions very fast. They don't have to make investment notes and circulate it to the various investment committees and all of those things. And in terms of their positives, they are willing to wait longer before getting an exit. Angels are willing to wait about 5 to 7 years to get an exit, and they can give you small amounts of money. They can give you up to about 20 lakhs, 30 lakhs, 50 lakhs in the Indian context today. It's a small amounts of money they'll be able to give. But whereas if you go to a venture fund, Now they will probably not be willing to give anything less than even a seed stage fund. They look at about $250,000. A $250,000 is about 1.5 crores. At a very early stage of the business, to be able to get 1.5 crores is significant dilution, right? And why would entrepreneurs want to dilute at a very early stage significantly when they can make do with smaller dilution? So those are some of the differences between angel investors and venture funds that I could think of. So the next question that is from Aradhana Sharma is how to seek funds from angel investors and procedures, and obviously that is going to be a little difficult to be able to answer in this webinar, and maybe I can take it offline or email and so on, because it's a very strange process, and then I'll probably also have something to share before I finish the presentation today. Let me see. Let me go to the end and then see if there are any questions that have come recently. Okay. What are the policy changes needed from governments to recreate the startup ecosystem post-COVID? See, the policy change is, I think there has to be a very clear differentiation between what are MSMEs and what are startups, right? So today they tend to kind of get bundled together in times of crisis like this, right? And what I would also suggest is today, unless until there are voices that can be heard by the government, nobody is going to hear the voice of the startups, right? So if you really look at the big industry, they have the voices to be had. They have CAI, you have ASOCAM, you have FICCI, you have several organizations that can lobby for their interests. And for MSME, there's a very powerful forum who can lobby for their interests. Today, the need of the hour is, or maybe this is an opportunity to create, I think there has to be a strong industry body that can back for the startups. And so today that is not there. And I think it's the right time that such an organization can be created, which can really take up the cause of startups. Because I find overnight the policy regime has completely changed by an extremely friendly to a very indifferent state. And then there is a question from Harish Shivdasani. Why should a business angel invest in a startup when business entrepreneurs themselves might struggle to get bank finances for themselves post-COVID challenging times? So it's a right question. Obviously, you will find it difficult to get bank financing, and that's why you need equity capital. So equity capital is something that that is available, and bank financing is simply not available at a very early stage of the startup, because most of the startups don't really have investment in manufacturing equipment. So today, if you really look at, if you go to the bank, the first thing the banks look at is how much of investment have the promoters made in manufacturing and equipment. Most startups today, they are involved in kind of, at a very early stage, they are involved in product development, they are involved in doing a pilot testing and all of these things. So there is no question of installing huge equipment, right? So therefore, bank financing is simply not available. But why would a business angel want to invest? A business angel would want to invest simply because he sees the potential in the future, right? So most of the time, business angels see themselves in a situation that they were in when they were starting out, right? Most of them think, I would like to help entrepreneurs who are in the same shoe that I was in when I was starting out, and if they find a valid business case, they would like to help the entrepreneurs. Right? Obviously, it is not a charitable help. They are going to make an investment with a clear objective that there are going to be financial returns, but then ultimately they are willing to take the risk. They are willing to take the risk and bet on the entrepreneur for generating that return. And many times what happens is most of the angel investors who have succeeded, they are well past their prime, in the sense that they are well past their prime in terms of running the business. See, remember, as we all see, the entrepreneur is at the peak of the energy between 30 and 35. So most of the investors are probably not in that bracket, right? They are probably much more senior, and therefore, though they would have liked to start the business by themselves, the ecosystem today is probably, they will not be able to be at their best. So therefore, they are willing to bet on an investor who is at the right age to be able to. In many cases, for example, I know several situations where the business angel provides an idea to a prospective entrepreneur who will run with it, right? So it may not be the idea of the entrepreneur, but the investor finds a suitable investor. So investor finds a suitable entrepreneur, and then he kinds of molds the idea that he has, and he gives it to the entrepreneur to run with it, because the entrepreneur has the energy and the investor has the capital. Okay, so then we have another question. Angel, there is a question from Atif Muhammad. Angel investors look for innovations. So how do we make India a destination suitable for investing, as our startups are necessity driven rather than opportunity driven, thus not attracting as many angel investors when compared to US or China? See, remember, we will have to we'll have to understand angel investors are those who are rich, correct? So obviously, when people are rich, one of the asset classes that they will invest is entrepreneurship. The US, there are more number of angel investors simply because there are more number of rich individuals in the US and more number of entrepreneurs who have become rich. So that is the reason why we have so much of angel investors that are there in the US. The same is the case with China, right? In China also, the number of people who have become rich in recent years have significantly improved, and therefore the number of the quantum of investment available is much higher. So those are the reasons, right? If you really look at innovations, I think there is enough innovation that is actually happening in India as well today. For example, earlier what used to happen in India, many people used to say that they are copycat innovations. Whatever happens in the US, they are bringing it in India. But today that is not the case, right? Today we are looking at developing new products and services that are completely homegrown. It's not a copycat of what is actually happening in the West. But just because we are not as rich a country and we don't have so many rich individuals like we have in the US or India or China, the angel investment is much lower. So to give you an example, in the US, for example, that could be about 2 million angel investors, right? In India, I think we are talking about a number of about 10,000, right? So that's a kind of a big difference that we are seeing, right? 10,000 versus 2 million investors. Then there is a question from Sankalp. What do you think would be the future of eco-friendly product startup? So obviously, you're talking about social ventures. Social ventures traditionally used to be able to look at generating or supporting enterprises that promote that not give so many returns. So ultimately, when you look at angel investors, when you look at ventures, much of it is going to be technology driven, and technology driven which is characterized by much of innovation, because those are the ones that have very, very high growth potential. Businesses that have linear or steady state growth may not be so attractive in the near future. I mean, it could be attractive when things stabilize, but then steady state growth businesses might not be so attractive. So if you really look at eco-friendly product startup, if there is an opportunity for non-linear growth, yes, I think it will still have potential. If it's going to talk about a steady state growth, then I think it might be a difficult thing, is what I would suggest. But on the other hand, there are always investors, right? There are always investors, who are willing to look at investments. So we should trick lies in approaching the right investor. So the question is an angel investment taxed? I mean, actually, there are multiple interpretations to this. Earlier there used to be something called as an angel investment tax. But today, what's actually happening is companies that have registered under the Startup India portal, they don't actually have to get taxed. So therefore, it's a very, very positive thing for the company. Earlier, the companies will have to pay a tax and so on. But today, if you're referring to whether the investors taxed, I think the investors are taxed when they make gains, as like any other gains that they make to investments. Then you have the question. So there is a question from Santosh. Isn't seed venture firm essentially a collection of angel investors? Then why do you believe that the segment will be down when compared to individual angel investors? So there is a difference here. Any venture fund is basically do not invest their own capital. They pull in capital from potential investors and then they make an investment. And when they pool in capital, it is not only individual investors who make an investment in the venture fund. There are so many other investors as well. You can have a corporate, you could have institutions, you could have many such players who are making an investment. And when we really have this kind of situation, it becomes very difficult to be able to justify and meet the requirements of multiple stakeholders of investors. And people could actually withdraw commitments. So earlier when somebody said I will make a commitment to the venture fund, but when the business segments turn down, they may withdraw the commitment. So therefore the seed fund might be unable to pull in the capital that is required to make an investment. On the other hand, if you look at an angel investor, the angel investor invests on his own. He doesn't have to depend on pooling of funds from other sources. So therefore if he is interested, he will make an investment. And therefore I would say that secondly, I am talking about the much of it is going to be occasional investors, right? And occasional investors do not invest in venture funds. Occasional investors, they invest directly in companies, and that is the biggest chunk of the segment that we are talking about in India today. So there is a question. My interest is Alan Krishnan. My interest is nutrition, health, and education in an integrated approach that is sustainable and profitable, where the investments are in the right area, provide return on investment used for funding growth. Yeah, I think that's more like a statement. I don't have anything comment. How to target angel investors? Where can I find one? There's a question from Manmohan Singh. So I would like to kind of take this question towards the end, and we are almost crossed 4 o'clock, and
so there are some of the questions I think from Ashwin, Meena, and all. Are you able to see that? Is it
towards the end?
Yeah. Or not towards the end, it has come after Adarsh Patil and Shirish.
Question from Ashwin Meena. Okay. So yeah, that's a question from Ashwin Meena. Okay. In investor proximity slide, can we think in this way that before COVID, founders might be able to schedule and physically meet easily, especially at short notice, if they are in the same city? Now, because people are open to digital meetings, it might increase finding from other cities. So it's a very interesting perspective, but if you really look at it, ultimately people are going to look at this as a long-term investment. So people are looking at, let us say, 4 to 5 year time frame, and in a 4 to 5 year time frame, this restriction might not exist for a long time, right? People would be able to kind of go ahead and monitor the investment. But then I will tell you, this investing in the same city is just an indicator for something else. So what is this indicator for something else is there is a common connect, right? So angel investors prefer investing when there is a common connect. The common connect could be on various dimensions. So investing in the same city is one of the most common forms of connect that we are seeing today, right? So if there are connects, but still if the investors are in different locations, the investor and the entrepreneurs are in different locations, the investment can still happen, but that is becoming very difficult. Investing in the same city, they are able to quickly find the common connects. Like for example, there'll be a common friend, or there'll be a common place that they go to. There'll be common interests, that they can share within the same city. So these are the things that drive investment, right? And the probability of that happening in the same city is much higher than happening in 2 different cities. So that's what I had wanted to infer. But your point is well taken, Ashwin, Meena. The idea is to really find out how do you find common connects between the investor and the startup. And then there is a question from Lata. Is there any forum community for angel investors? I think today there are plenty, right? Today there are plenty. There are so many city-based angel networks. For example, you have Mumbai Angels. Now Mumbai Angels, they call Mumbai Angels, but then they have a branch office in every other city. For example, you have Mumbai Angels in Bangalore, you have Mumbai Angels in Chennai, and so on and so forth. Then you have, let's say, I'm not sure about Bangalore Angels, but I'm sure there should be one Bangalore Angels. We have one in Chennai Angels, and there is one for the entire India. It's called the Indian Angel Network, and so on, right? See, one thing that I would want you kind of leave with is, see, most of these community, they take care of the interest of the angel investors, right? So that's very, very important for you to understand, right? So as an investor, most of the investors take pride in being very, very selective in making an investment, right? So that means the India Angel Network says that they look at 25,000 investment opportunities in a year and they make 25. So that is their pride, right? That they are able to see so large number of deals and then they are able to make an investment very selectively. But as an entrepreneur, please consider this, right? When you apply to an India Angel Network, what is the probability that you are going to be in the 24,990 75 as compared to the 25, right? So the probability of being rejected is much higher in these kinds of investment communities, simply because that is the rules of the game. So what we thought about is, as an entrepreneur, it doesn't make sense to be able to adopt this kind of a spray and pray approach where you just simply apply to as many angel investors that you can and then wait for some angel investors to like your proposal, right? So that's probably not a very, very efficient way to be able to look at, because as startup entrepreneurs, I think you should spend as minimal as time as possible in fundraising, right? And it does not make much of a it is not much of a medal for you when you go and say that I've looked at I've approached 40 different investors and then I got an investment. No, right? I think you should be more proud when you say that I approached only one investor and I got out my investment out of that investor. Having this kind of an approach, approaching investors selectively will help you to reduce the frustration and will help you to reduce the time that it takes, in spending meetings with various investors, right? You can keep on spending meetings with various investors without getting any investment. I mean, obviously you'll get a lot of advice and sometimes you'll get conflicting advice, right? And managing that is going to be extremely difficult. So you might want to kind of quickly finish the investment fundraising process by meeting as few investors as possible. And for that, what we have done is, I run, as Sushma had probably mentioned in the beginning, I co-found a company called YNOS, right? So YNOS, we call ourselves as an entrepreneur first company. And our objective is to see, can the entrepreneur raise capital by meeting as few investors as possible? Because for them, it is important to spend the time on the business rather than fundraising. And for an early stage entrepreneur, there is nobody to help. For example, if you become a who's who that I talked about in the presentation, so there will be an innocent banker who will do the job for you, right? I mean, you can give him a 5% or a 6% cut, and then he will go ahead and raise capital. But for an early stage entrepreneur, we're raising about a crore and a half. I mean, there will not be any innocent banker who can do the work for you, right? So you will have to go ahead and do it yourself, and that is extremely time consuming. So therefore, you have to choose what is called as the shortest path to be able to raise capital. So what we do at YNOS is to be able to identify recommendations for potential investors, right, whom we think would be the best match for your startup. So today we are talking about, let's say, there are 5,000 angel investors in India today, right? So how will you contact the 5,000 angel investors? It is so difficult, right? Most of them, they don't even advertise where they are and what kind of companies they invest, right? So it's important to be able to what I would call a scientific approach to early stage fundraising. And I would kind of welcome you to take a look at what we offer at YNOS at www.ynos.in and understand that we are trying to bring in a systematic approach to be able to identify investors so that you shorten the fundraising process. Right. So I will probably give the website here, which you can probably approach, look at it, once the webinar is over. So are there any other questions, Sisma? I mean, because I'm just looking at.
Sir, if this one is answered from Abhishek Das, the question is like 1 second.
So while you search for the question, let me also give
there is one, sir. RCEP Regional Cooperation on Economic Partnership. Was that answered? Is it?
No, not really. Actually, can you help me to?
Yeah, I'm just sending it to you now. It's a long, or I'll read it for you. It says regional cooperation on economic partnership can be considered as an angel investing if we see the dairy sector in India. I belong to the sector, so do you think such opportunities which were muted earlier can be considered now?
I'm sorry, can you repeat the first sentence?
RCEP, he says, regional cooperation on economic partnership can be considered as an angel investing or not if we see the dairy sector in India.
Angel investors have a very specific definition, which is basically they are all individuals. So once it is not an individual making an investment, but it is an organization. For example, let's say it could be a federation, or it could be a cooperation, or it could be a corporate. Then it is no longer seen as an angel investment. They would broadly come under what is called as a corporate investment, right? I mean, it may not be strictly company, but then essentially these are all organization that is making an investment. The decision could be made by an individual to invest or not, but then ultimately, it is the investment comes from the books of an organization, so they don't qualify as an angel investment. I mean, they're still venture investments, but then the dynamics might be a little different, and the way it happens might be a little different. And then I'll probably take this question from Arushi as a final question. So it says, do we have to pay back to angel investors? Of course, we have to pay back to angel investors. Angel, the prefix angel in angel investors doesn't actually reflect the true meaning of angel. So they are hardcore commercial investors, right? I mean, it is an investor that actually has a lot more weightage. So they would expect returns, but they are willing to wait to get returns, but they are willing to expect returns. So they would expect to get returns before the promoters get their returns. I mean, that is reasonable, isn't it? I mean, as promoters, we will have to give returns to our investors first before we can actually look for getting returns for ourselves. So yes, payback is needed. Payback can be in multiple forms. The next round of investors can buy, or the company does very well, the promoters can buy back from angel investors. But it's important that in fact, the entrepreneurs have a very, very onerous job to pay back angel investors, because only then the cycle can continue, right? So only then the angel investor can invest in the next startup, right? And the next generation of entrepreneurs can get benefited. So it's important, that the cycle continues. As entrepreneurs, we also have to ensure that, and obviously, entrepreneurs can fail, businesses can fail, but wherever possible, it's a duty of the entrepreneurs to be able to give returns to their investors.
Sir, probably can we take one last question from Mr. Alan Krishnan and end?
Yeah, sure. Okay.
Because sir is our senior alum. He's a PGP 1981, and I think he has joined from US. So, yeah.
Sure.
Yeah.
So the last question that Alan Krishnan is the one, right? Who are the best investors in India for startups for social good, which are commercially viable and sustainable? So the rate of return is not deciding criteria, but being commercially viable and sustainable is the driving force. Investment is for infrastructure, marketing and growth, and not for payroll to promoters. No, it is very difficult for me to actually offhand, give a name from the top of my head. So it needs a little bit of, analysis and so on. But I'm sure today we have a spectrum of investors. There are impact funds, and then there are individuals who are actually investing in social enterprises as well. So if you're really looking at, any of those. See, one of the thing is, many of these social venture funds, they have a very strong sector focus. For example, there may be a need, there may be a very strong social relevance for a particular sector, but they may not give the minimum return that the investors are expecting. So therefore, despite being a strong social need, because the inability of the sector to meet the minimum return requirements, we may not find many investors. So most of the social sector investments today, it actually happens in health tech, they actually happen in fintech, they happen in edutech and so on. But for example, in places like let's say water supply or on sewerage management, we not really find so much of startup investment. So before I end, I wanted to just pass on one thing, and I wanted to quickly summarize. So I started the question, with what should the last man standing do, which means that what would the investor do, right? But now I would like to rephrase the question, saying that this talk was largely focused about entrepreneurs, and the call to action is what should the startup founder do, right? We kind of guessed what would the investor be doing, but I think now that our next call to action is what should the startup founder do, what kind of investors should they approach, and so on. And here is where I would like to kind of briefly leave you with the solutions that we offer. If you go to our if you go to our company YNOS, and I would like to actually look at our Discover platform to be able to identify potential angel investors, and it is probably a systematic way to be able to identify and reach out to investors. And there are some, I see there are some people who have joined academia as well, and then some have requested for contacting for collaboration and joint work. So I will leave my email ID here. I'll leave my email ID here, and feel free to write to me, and it will be a pleasure to catch up and collaborate. I would also be very glad to get connected with the participants through LinkedIn, and you can actually search for my name in LinkedIn, and if you could kind of give a send an invitation to connect, I'll be most glad to be connected. And it's been a pleasure, and I was a little nervous when I started this session because obviously we are going to have high flying achievers from a top institute like IIM Bangalore join this webinar, and I hope the talk added a little bit of value to those who are present. And thank you everybody for being here on a Friday afternoon when we are really winding up a very hard week. I'm really honored with all your presence, and thank you so much. I will leave it to Sushma to.
Yeah, sir. So thanks a lot, sir, for presenting the webinar. I see a lot of participants have been definitely benefited from this session. I can see a lot of the chats saying all that. And I have also shared a webinar feedback form to all the participants. I request all of them to fill it so that I can share it with the professor also. And yeah, and we will be, IIB Alumni Office will be organizing webinar in this month every week. I think next week also we'll send the invite. Yeah, I think, yeah, we will close the session. Yeah.